Netflix wants to buy Warner Brothers for $72 billion that it doesn't have. Will Hollywood allow it? Will regulators in Washington allow it? We'll discuss that. Amazon made a slew of announcements this week, including potentially 30-minute delivery. What is Amazon going to have to do in order to deliver packages and goods within a 30-minute window? I have some ideas. It announced partnerships on the data center side with Google. We'll have to discuss that, but we kick things off like we always do with Meta Platforms. Started the week at 639, and since most of us backed up the truck, and that's what has me so excited about Meta. I know I'm not the only one that just backed up the truck. Some of you got the Corolla and the Prius and the Tesla in reverse, and you backed it up, and we are celebrating again on Friday as shares of Meta Platform up 5%. Can you tell I have a big stake in this one? Because boy, it is great when it goes up. Now, the CEO is planning cuts to the metaverse project by up to 30%, and this has shares of Meta and investors celebrating because, as many of you know, the metaverse has been a meta flop for Meta. After they changed the name and the focus of the company, it just has gone in the wrong direction, including $73 billion in losses. That just ironically is the number Netflix is trying to pay for Warner Brothers. So Meta has spent a Warner Brothers Discovery amount of money on the metaverse and has almost nothing to show for it other than some actual good form factor to the glasses. And I think longer term, I think this is money down the drain, but it's not 100% over. However, the cuts in the metaverse could be reapplied to AI when you analyze Meta's business. When it comes to AI, they're making some nice progress when it comes to showing ads and making money. And that is exactly what you want the company doing. Now, they are hiring a long-term executive over at Apple who has been in charge of interface design for over a decade. Now, if you have one of the new iPhones, the liquid glass requires some tweakings of settings, but eventually you dial it in and it's not the worst thing. But this is somebody with some experience there, somebody that can definitely make any type of interface slightly more elegant than probably what Meta has in-house. This also shows you the direction that Meta is trying to go in. They've got the glasses. They'll probably come up with some other form factors and some other devices, and that'll put them squarely in competition with Apple. On the AI side, they're signing pacts with news services in order to deliver more current events inside of AI summaries found on the platform. This is one advantage that Grok has, is that they have a fire hose of data of Twitter behind it. And so when you ask Grok a question, it could actually be something that has happened in the past hour or two, and the AI system is capable of handling that. My belief is that Meta could eventually morph some of its AI systems into that, but partnering with the news agencies is one way to shortcome that. Now, if you continue to hold Meta shares like I do, on the 23rd, you'll get 52 cents a share, and that's one of the bonuses. Now, moving on to Apple. Started the week basically where the stock was at 278, went up, came back down. We finished flat. At a key technical level, we'll show that to you. But we've got some very interesting things under the radar headlines I haven't been seeing other people talk a lot about when it comes to Apple. Now, their iPhone sales, as most of you know, absolutely on fire. The revenue from the iPhone, 40% month over month. The company, when they reported their earnings just a couple of weeks ago, said that, look, this upcoming quarter was going to be absolutely fantastic, accelerating to double-digit revenue growth, something that we just haven't seen with Apple in a while. Now, I haven't seen people talk about this. They're talking about it in relation with Dell. Also, on the high-performance computing side, the memory and memory prices have skyrocketed, with companies like SK Hynix and Micron and Samsung jacking up the prices. And so that is warning to PC makers like Dell that they are going to have to increase the cost. That is because Dell, when they sell a PC, they're not making a lot of money there. We're talking like low single-digit margins oftentimes. And so Dell is planning price increases by 15 to 20%. Now, the interesting thing as it relates to Apple is they negotiate their memory contracts well in advance. And my research shows that the company has locked in low prices for memory for at least the next year. And so that means as competitors are going to have to raise the price, because this is not just going to be on the PC and laptop side. This is going to be on the smartphone side as well. If you have not locked in your memory contracts for the next year, and my understanding is most device makers have not done that the price of these devices, both on the cell phone handset side, but also on the PC and laptop side, these devices are going to have to raise price while Apple is going to be able to maintain price. And so there's some belief there that Apple will gain market share in PC and laptop and maybe tablet, but also on the handset, as well as you have competitors that are going to be forced to raise price or maybe absorb the cost and maybe go unprofitable on some devices. Only Apple is going to be able to survive that. They hired a former Google engineer to help with their AI goals. I think this is more or less telegraphing that they are going to partner with Google on a lot of different projects. And I believe going forward, I'll have a story when we get to Microsoft, something that Mark Benioff said on the Salesforce conference call earlier this week, that these large language models will become commoditized. And I believe he is correct. We'll discuss that more in depth here in a moment, but we've got to get to Amazon. Start of the week at 234. How is this stock not at a 52-week high? I think it's one of the biggest crimes inside of the stock market at the current time. Shares are even down this week, 2%. I think you've got a great opportunity here. Amazon closing at 230. This comes as the company is back to investing in ultra-fast delivery. Some of you might remember right before the pandemic, the company was making big strides in delivering a lot of stuff same day delivery on a wide assortment of goods. I remember being on Amazon in the morning, clicking buy, and the goods showing up. And then obviously the pandemic hit, and that just screwed up a lot of different things, delivery times, the ability to have enough employees to deliver those things. There were shortages of goods. So Amazon had to shelve that for a while. Well, they're revisiting ultra-fast delivery. In fact, they want to bring some orders of groceries and other key merchandise to under 30 minutes. In order to do that, they need to build or renovate small delivery hubs inside of large metropolitan areas. My guess is this would initially be in the San Franciscos, the Philadelphias, the Miamis, the New York Cities potentially. These will be in the major metros. In order for Amazon to pull this off at scale nationwide, and we're talking primarily here in North America or really the United States, I believe they're going to have to make an acquisition here. I think they could buy a grocery chain. I think they could buy a retailer, not like a Target or something like that, but there are Kohl's, there's TJ Maxx, there's potentially a retailer in distress. A few years ago, it was Big Lots, and then there's been a handful of others. Maybe there's a Staples or an Office Max or one of these other type of companies that you could acquire, get their real estate portfolio and their footprint, and then retrofit those to have ultra-fast delivery. Because right now, it's really going to be the Target and Walmarts that are going to be able to move a little bit faster here. So we'll see if this is where the market goes, that ultra fast delivery is the selling point. And when I've listened to the Walmart conference calls, the executives are investing heavily here because they're seeing an uptick in orders, an uptick in spending, an uptick in profitability, the more they deliver things faster. And so Target is going to be testing overnight delivery as well with different sorting centers and gig drivers. This is going to be the trend as you move into 2026, minus a pandemic interrupting this, because again, this was the trend in 2018, 2019, and it got disrupted. And now these companies are going back to revisit it. It's probably something that plays into the competitive landscape and the competitive hands of an Amazon. This comes as the company is going to team up with Google to unveil multi-cloud services for interconnectivity. This has some relevance because, as most of you have probably experienced, there's been some outages with AWS. I don't know if Google Cloud has been down more recently, but when AWS is down, everything is down. So think about it from an organization standpoint. If you have all your eggs in the AWS basket, when it goes down, your whole business shut down. Well, the two clouds have decided to come together to create some redundancies So a company could have an instance maybe on AWS and maybe also a backup instance, if you will, on Google Cloud. So if one goes down, the other one can come in. Very interesting partnership, in my opinion. Now, also in the data center, this Trainium 3 chip, there were some rumors, there were some delays here. I do believe there is some volume production that is still delayed. However, those are available on Ultra services, with primarily Anthropic being the lead customer there. But if Anthropic really works this out, creates some really good models, there'll probably be other companies coming in behind them. Now, on the CPU side, they're on their 5th generation there. This is essentially kind of eats away at market share that Intel and AMD tend to dominate. It doesn't reduce the cost as much as these AI chips. So these AI chips can be reducing costs by as much as 50% compared to obviously Nvidia, which has 75% gross margins. These deliver better performance, but AMD and Intel chips don't carry 75% gross margins, so the cost is not as good. Now, Amazon continuing to invest in their delivery network, and they might be ending a long-time partnership with the United States Postal Service. This is a postal service contract that generates $6 billion in 2025 for the United States government. I think what the government should do, and not that President Trump or anybody from the administration is watching, but this should actually go in reverse. That instead of Amazon paying the United States Postal Service for capacity, it actually should go the other way at some point. The Postal Service should handle or offload certain packages onto Amazon and actually pay Amazon for that. Now, I understand there's union jobs and there's government jobs at stake here, so the likelihood of something like that happening is rather slim, but over time, Amazon could become a gigantic partner of the United States government and not just a payer. Now, moving on to the stock of the week, and that is Netflix. It started the week at 106, and this is after being down by over 7% over the past month, and over the past 6 months, shares of Netflix down 19%. This week, sliding 6% on the news that it offered $72 billion for Warner Brothers Discovery. I'll remind you that Netflix, out of all of these companies, has the smallest market cap of just $437 billion. So a $73 billion valuation, or $72 billion. Now, to Google is still a lot of money, but they could reach into their pocket and pull it out. There's a handful of other companies, including Apple and even Amazon, and quite frankly, even Tesla doesn't quite have $72 billion, but they could come up with it. For Netflix to come up with $72 billion will require some financial engineering, and I do believe that the market is pricing that in. The other thing that they are pricing in is the fact that nobody is excited about this deal. Nobody in Hollywood and nobody at the federal government, including Senator Warren, who says that Netflix buying Warner Brothers is an anti-monopoly nightmare. There's also some on the conservative side that is saying the same thing. The founder of Netflix, or one of the founders of Netflix, is a Democrat mega donor. So when you have mega Democrats coming out and saying that this is not a good thing, it's probably not great for Netflix. Now, I saw some commentary on this, that this is likely a deal that will likely get held up in courts and regulatory and all these types of things for several years. And so it is one way that Netflix, for a $5 billion breakup fee, because I believe that is the breakup fee that has been agreed to by the companies, and I don't think this has been signed, sealed, delivered yet. But if the deal starts to go forward and you got to get through all the regulatory stuff, there's a $5 billion breakup fee, but that $5 billion will probably stretch out over 2 or 3 years. It's potential by the end of that deal that Warner Brothers has just withered on a vine, if you will. And so this could be one way for Netflix to keep Warner Brothers out of competitors' hands, but also tie it up in expensive and time-consuming litigation for the next 2, 3, 4, 5 years, however long it takes. And it only costs the company $5 billion. And during that time, Netflix gets stronger and stronger. We'll obviously monitor that for probably the next couple of years. Moving on to Nvidia. Start of the week at 175. My chart always comes up a little short on Nvidia, but we were up by about 3.6% on the semiconductor giant as we are approaching over $180 per share again. This comes as the company continues to invest $2 billion in Synopsys, which designs software which is critical in the role of semiconductor design. My only regret is not buying Synopsys stock sooner myself because it's been a decent performance. Now, SoftBank, like many of us who have sold a stock potentially too soon and too early, or maybe had such a large gain that at some point you got to take some chips off the table. We're not the only ones crying. SoftBank founder reportedly cried over his decision to sell Nvidia. On the memory front, Samsung is entering the fray on HBM. As most of you know, the high bandwidth memory, this is what is surrounding the very expensive Nvidia GPUs and even the XPUs that are made by Google. This is very expensive memory. You also have just a couple of companies that are able to manufacture it at scale. Micron, if you look at the stock chart of that, it's just taken off. SK Hynix also done a great job. Samsung's entering the fray on HBM4, potentially creating more supply. I think pricing for all these companies is probably going to be very strong as we move into next year. But this could allow the fact that you could have a few more chips manufactured because in the past, HBM has been a bottleneck. The CFO of Nvidia saying that the OpenAI deal, and any deal with OpenAI, will put in these big air quotes because this is a company that is on the ropes. It's also a company that is not generating the amount of money that it has agreed to pay companies like Oracle and even Nvidia, which agreed to a $500 billion of orders for Blackwell. The forecast that Nvidia has doesn't even include that. That is because OpenAI doesn't have the money. Now, on the model side, you have Mistral, which is a French AI startup. I throw it in here in the semiconductor segment because ASML, which makes the lithography machines that are required to make NVIDIA chips, they actually made an over $1 billion valuation or a $1 billion investment in this company that makes open source models. What was interesting is they released some open source models that were still trained on H200 GPUs. The reason why I point that out is a lot of the models that you're going to be seeing released in the next couple of months, including one probably forthcoming from OpenAI, will be trained on these NVL72 GB300 or GB200 racks. These are the most advanced systems of Blackwell. We've been hearing about Blackwell for almost 2 years now. And really all of this year, it has absorbed a lot of sales, particularly in the last quarter or two for NVIDIA. It's been a huge chunk of sales. But what we haven't actually seen is the result of these. These things have been bought. They've been recognized as revenue, but they're actually just being fired up as we speak inside of data centers. And so we actually won't see models trained on these high performance systems, which are drastically bigger and better than the previous Hopper generations. We actually are not seeing models released on this until probably next year. And so that is very exciting from an AI standpoint. And it probably means the race for who has the best model is just beginning. This comes as on a regulatory front, NVIDIA securing a victory as Congress shot down a chip export restriction that would have required NVIDIA to sell chips to United States-based companies versus China. Right now, China is not buying a lot of NVIDIA chips, and they probably would like to keep it that way. Running all these chips, including the Blackwell, is a CUDA software platform, and that had its biggest expansion since 2006. And many in the engineering space and anybody that dives deep into the weeds understands that one of the moats, the largest moat potentially around NVIDIA's business, is actually on the software side. So continued expansion there should keep NVIDIA in a pole position. Moving on to Google. Start of the week at 316. And has this stock gone down in a while? No, it hasn't. We just continue to blast higher with Google as shares were up 1.4%, finished the week at 320. OpenAI issued that code red internally based on the success that Google had with their Google Gemini 3 model. Companies trying to move quickly, and they might have something cooking by next week, including an AI model that they call Garlic, which I would assume is kind of a rush to market post-train type of model, which is just layering on an incremental amount of compute onto the current model. But the one thing that OpenAI is missing, And the one thing that the market has woken up to is that not that Gemini 3 is so much better than OpenAI or Anthropic. It's good. I'm sure it's good. I'm sure it's better at some things. And depending on how geeky and how intensively you use these things, one could be better than the other. But to the average user, to the average person that exists, they really couldn't tell if you didn't tell them the responses, if it was Gemini 3, GPT-5, Anthropic 4.5, or Grok 4.1. If you just gave somebody the response, they probably couldn't tell you which model generated it. So what does that mean? The most important aspect of AI is not the model. It's not the large language model. It's not even really necessarily the chips that they get trained on, although there are some economic benefits with Google having their own proprietary system there. What is it, guys? It is distribution. Google was able to roll out Gemini 3 to search engines in nearly 120 countries with a snap of the fingers. That is something that OpenAI can't do. That is something that Anthropic can't do. That is even something that many of the other models can't do. And so the large language model is becoming a commodity. And that is what Mark Benioff said, not only on the company's conference call, but he followed it up basically with a highlight thread on his own X account. He picked the one sentence that he said during the company's earnings conference call and decided to share it. So you know this was important. He said, large language models are the new disk drives. This is commodity infrastructure that you can hop swap whoever's cheapest and whoever is best. The fantasy that the model is a moat has just expired, and I do believe Mark Benioff is 100% correct here, that when we look back in 5 years, it's not going to really matter the capabilities of the model because they're all going to be like disk drives. There's going to be some small advantages some might have, but in the large scheme of things, it is a commodity. You don't know when you put gas in your car, whether it's Chevron or it's Exxon or it's Shell. It doesn't really matter. When you press the accelerator, the car goes. The same is largely going to be true with AI. Now, there's going to be special use cases. I'm not going to argue that. But broadly speaking, to the average user, they're all going to be very much the same. Very similar to search engines. It's not that Google's search engine is that much better. It's that they have distribution into the browser, into the lexicon of Google. That is what the competitive advantage is. This is why when Meta stock went on sale, we backed up the truck, because what does Meta have? They have distribution. They have the ability to serve this model to you on the world's largest social media platforms, just like Google has the ability to serve their model, which may be better, may not be better, may be the same. They have the ability to do that. This is also why Apple stock has continued to rally, because they don't have a large language model. But it doesn't matter, because when you can hot swap to whoever's the cheapest and the best, when you have the distribution of the iPhone, that is what matters. Now, FluidStack, which is one of these companies that is essentially converting crypto miners, including TeraWulf, Cypher Mining, I believe Iren as well, might be a customer. What we are finding is these crypto miners, they were good at setting up data centers with crypto mining equipment, but they are correctly analyzing that high performance computing requires cooling, different power infrastructure, redundancies, all these types of things. It's very expensive, and it actually requires a hell of a lot of expertise. This FluidStack company has partnered with Google and also Anthropic as well to retrofit or convert a lot of these crypto miners. The mistake the market, or some in the market, is believing is that TeraWulf and Cypher Mining are these moguls and they're doing things. They're really sitting as just kind of a middleman in between here. They'll make a small amount of money, but their business model is absolutely terrible. However, FluidStack, very interesting company. They're in talk to raise $700 million at a $7 billion valuation. They found some useful idiots over at TeraWulf and Cypher Mining and Iren, but at the end of the day, the hyperscaler is going to be the one that wins. Moving on to Microsoft, start of the week at, we'll call it 486. This one's slipping lower. Interesting spot technically at 483. OpenAI doing some small acquisitions, including Thrive Holdings, which was founded by Joshua Kushner, son-in-law of the United States president. They offer artificial intelligence applications for accounting and IT services. They also acquired this Neptune company. This is kind of the plumbing of the training of the artificial intelligence models. So internal task over at OpenAI, potentially helping them make their models better. Earlier in this week, though, there was a report that Microsoft had to cut software sales quotas or goals that it had for its sales staff, that it had to actually cut those based on artificial intelligence sales. There was some belief that potentially Copilot isn't selling well. Copilot isn't able to charge more than maybe a typical Office subscription. This would be bearish, obviously, for a lot of things, including Microsoft's ability to actually earn money and revenue off of the large investment that it's made into OpenAI, but also into its Copilot and Azure data center platform. I believe Microsoft is under pressure. That is because it is so closely tied to OpenAI, and OpenAI is in a position where it's a possibility. I mean, the chance of OpenAI crashing and burning like Alta Vista did, or AOL did, or many of other internet companies, the chance of OpenAI crashing and burning is higher than zero. And in fact, depending on who you ask, it could actually be a relatively high number based on the commitments that it's made and given the competition it's up against. It's up against Google. It's up against Meta. It's even up against Elon Musk and Grok. And in some cases, it's even up against one of its lead investors, Microsoft, which has the resources to invest in these OpenAI models. And if Mark Benioff is correct and the LLM becomes a commodity, then it becomes down to distribution. And that is something OpenAI will continue to need to work on. Moving on to Tesla. Start of the week at 427. This one climbing the wall of worry, up over nearly 6.5% to finish the week at 455. This comes as the company is rolling out a, quote, low cost, we'll put that in air quotes, low cost Model 3 variant in Europe. Currently, the Model 3 sells for about $45,000, which seems like a lot. Same model sells here in the United States for closer to $37,000. These lower price versions tend to have slightly less features inside of the car, like maybe cloth seats, but also tends to be just rear wheel drive, so reducing some acceleration. The Trump administration rolled back fuel economy rules, which required companies like Ford and GM to really invest heavily in EVs and potentially lose money or lose the ability to focus on the cars and trucks that make those companies lots of money. I think this benefits Tesla because Ford and GM and these other companies, they've been trying to make EVs and they just really haven't made them profitable. And oftentimes they've had to scale back their ambitions there. This will allow Ford and GM to make these big, large Super Duty trucks and these very expensive trucks that have very high profit margins. It'll allow them to make those and allow Tesla to focus on what it does best. And for the most part, that's to make electric vehicles. However, if you ask the people in France and Denmark if they like Teslas, right now they are not. Sales slumped in those regions by 58% and nearly 50% in Denmark, is they are selling just hundreds of units of cars in these regions. I still stand by my assumption that Tesla can rebuild its brand in these regions. The history of brands that have screwed up and people don't like them for whatever reason, it is a long, long list. And there's also a long list of brands that have recovered, and they almost always recover. Number one, it takes time. Number two, you have to attach the brand to something. And I'd find some football and soccer stars, cricket stars, or whatever's popular in these regions. I'd give them a couple of bucks, put them in a Tesla, and you'd be surprised how quickly people's attitudes will change. Moving over to the technical segment. I mean, this is a beautiful uptrend we are in, folks. And this is super, super durable. We are just a stone's throw away from the all-time highs. I tell you what, if you can push it back into the all-time highs by year end, which seems almost inevitable at this point, this little drop that we had was a buying opportunity. Speaking of buying opportunities, Meta backed it up all the way down to the bottom of the channel. I backed it up so hard into this stock that every single morning I wake up, even in the after hours, I'm checking of the price performance of Meta. Couple of key things technically. We closed above the 200-day moving average, which is a squiggly blue line. That is good. You have a close above the 200-day. The 200-day is flattening. You also have a gigantic gap. There's a gap here between where the stock is right now all the way up to 704. That creates some airspace. Momentum stays in this one. We might be able on next week's show saying we're at 700 on Meta. You could also say there's a secondary gap all the way back into the 750s. In fact, that would just take you back into the middle of the channel. Very normal reversal as you come back down to come back to middle of the channel. That would take you back into the 750s. You still potentially have a ways to run. Not that you need me telling you what to do. And I don't think you should follow me into every trade, but my money is still on this one. Now I have my risk completely controlled on this one. At worst, I'll make about $1,000 on Meta. I have stop losses. I have an options trade. When I say back the truck up, I backed it all the way in with this one. We are talking a mid 5-figure type bet on this one with mid 5-figure upside just to close this gap to 750. And if we push into the highs, which I believe is possible as we move into next year, as you get approaching earnings with Meta, I don't think anybody's going to be on the other side of this as we enter into a Q4 stage. I know I'm kind of pumping my own book here, but I know about half of you or more want me to get on here and pump my own book because you're in the same book. Guys, we could push to a new high on here back up into the $800 range. I think pretty comfortably. Wouldn't be a big deal. That would be, at least on paper right now, a 6-figure score. Now, Apple, create a new high, is pulling back. These are areas where if you want to take profits on Apple, these are the areas where you will likely do it. Amazon is looking absolutely fantastic. It just bounced off the 200-day. We've confirmed a new higher high recently. These are areas that you should be accumulating the stock. Netflix looking absolutely terrible. This chart is ugly. We've just confirmed a new lower low, confirmed a new lower high. The 200 days moving over. There's nothing about this chart that says it's bottom. We'll probably look back and be like, this was the bottom, but there's nothing about this chart that says you buy the dip on this one. Nothing. Now, I wouldn't blame anybody having a longer term view. If you have a long-term 5, 6, 10-year view on Netflix, not the worst spot to buy stocks, but technically, again, this is the technical segment of the show. There is nothing on this chart that says you should be buying that stock. Nvidia, trying to find some footing in this area in the 180, very logical area. There is, heavy support in the 160, 165 range. You're a long way from earnings, but you do have Broadcom earnings next week, which should probably help Nvidia, I would assume. Google, if you're in Apple, the reason why you don't just automatically hit the sell button is Apple could make this type of move. Google way overextended. You're waiting for pullbacks in that one. Microsoft sitting right on a 200-day moving average. This is a very interesting spot. You don't got earnings for about 60 days on this one. Should find support here. Doesn't mean it rebounds and moves higher, but you should find support there with Microsoft. And then finally, Tesla, it wants to come back up here and retest these highs. That is a good sign if you are long this stock. You want it to push up above 480. You push up above 480 on this one, you could be at $600 in like 30 or 40 days. Company will report their earnings usually before the rest of the Mag 7. In about 54 days, I don't know what could necessarily get in front of this one. All of the bad news has been absorbed. The fact that they have declining sales, the robo-taxi rollout, as with most things with Elon Musk, is aggressively talked about, but it's more measured. Right now, this one looks great. You've got support at the 200-day and really the middle of the channel. This one is on breakout alert, and that's what we'll be watching for in the weeks ahead. Folks, that was the FAANG Stock Recap Show for Friday, December 5th. As always, the content of the FAANG Stock Recap Show was actually brought to you commercial-free. Thanks to all of the subscribers that signed up this year for Equity Empire. Really appreciate all of you. There's been so many of you. In fact, every single day there's more. And so I just want to say how much I appreciate it. If you want to come in on the journey, there's always links down in the description below. But as always, I appreciate everybody that is watching and is tuning in. And I hope that some of the information can both entertain you, but also potentially make you some money as well. I'll be back in 7 days. We'll see where Meta stock is, but I tell you what, we're in a good mood today. And if it goes even higher next week, we'll continue to celebrate. That was the show for this week. Have a safe and fun weekend. I'll see you again soon. Good luck with your investments.